Annuities are the easiest way to establish retirement income, full stop. But there are a lot of options out there, and it's hard to pick out which ones are right for you. So let's give you the rundown on your annuity choices. Hi, I'm Brandon, founder of the Insurance Pro Blog, licensed insurance agent, and I've been in the business of helping people choose life and annuity contracts for about 20 years now. And when it comes to retirement income planning, the data consistently tells us that Americans really don't like the prospect of selling their assets to supply themselves with the income that's necessary to support their lifestyle in retirement. Instead, Americans strongly prefer guaranteed income sources like Social Security, pensions, and annuities. But since pensions are becoming a dying option for most retirees, the two remaining choices for guaranteed retirement income, being Social Security and annuities, likely put everyone in a position where annuities are going to have to pick up the slack. But the options are plentiful and at times quite confusing. So I'm going to attempt to help you pick through, at least from a very beginning standpoint, the annuity options that exist and help you match up the right choice for you. There are essentially three different categories of annuity. We have income annuities, we have multi-year guaranteed annuities, and then we have what I'll call accumulation to income style annuities. And that last category is by far the broadest. It'll take the most time going through today, and we'll leave it for the last part of this video. We'll start with the simple one. Income annuities. These come in two flavors. We have single premium immediate annuities, and then we have deferred income annuities. Single premium immediate annuities are very simple contracts. You pay the insurance company a premium and they start paying you income immediately. Well, actually in about 30 days if you want to get really, really technical. And if you've been a long-time consumer of the Insurance Pro Blog, you know we do tend to like to get really technical. But once that 30 days has expired, you begin collecting income from the insurance company that is guaranteed for whatever period you've chosen it to be guaranteed for. The income options on SPIAs fall into two categories. You either have a period certain, which means you've chosen a number of years that the insurance company is now obligated to pay you an income, or you have a life contingent income, which means the insurance company is obligated to pay you an income for the rest of your life. You can also add refinements to the life contingent income option to add a period certain on it, or require the insurance company to at least pay out the premium you gave them at the outset, whether you're alive or not. So what this looks like, we'll use two examples. A contingent lifetime payout that has a period certain means that, let's say you tell the insurance company you want a 10-year period certain. So the insurance company is going to pay you income for the rest of your life, but no less than the next 10 years. So if you die 5 years after you open the contract, the insurance company is going to pay a beneficiary the income amount for the next 5 years. Once it gets to the 10th year of payouts, income will end. Alternatively, if you don't die, you'll still receive the same amount of income. It'll just continue beyond years 10. The refund of premium option obligates the insurance company to pay out at least the amount of money that you paid them. And you can take this in two different approaches. You can either have the refund be a lump sum payment or a continuation of your income until it equals payments totaling your initial premium payment. So for example, let's assume that you pay $100,000 for a single premium immediate annuity that will pay you $8,000 for the rest of your life, with the understanding that you also have a cash refund of premium if you die before the insurance company has paid out $100,000 in income to you. 5 years into the contract, you pass away. That means you've received $40,000 of income. The insurance company has a remaining $60,000 in hand, which it will immediately cut a check for to your named beneficiary. Alternatively, you could request the refund come as an installment refund. This means the insurance company will continue to pay your $8,000 a year income until total payments equal your original $100,000 premium. So using our previous example where you die 5 years in and you've collected $40,000 of total income up to that point, the insurance company will continue to pay $8,000 to your named beneficiary until those payments total $60,000. Single premium immediate annuities have no restriction on the type of account you can put them in when it comes to retirement options. You can use IRAs, both traditional and Roths. You can also choose to take money out of the bank or brokerage account and buy what we call a non-qualified annuity. When it comes to deferred income annuities, though, you do run into some restrictions on the amount of money you can take out of a traditional IRA to purchase the contract. The reason being, income annuities do not have cash value. So once you make a payment to the annuity, that cash is essentially gone. A deferred income annuity pays income at a later date. So when you open the contract, you establish a payout period sometime later in life. The good news is the insurance company will tell you exactly what that income amount will be. But it's also possible that you won't live long enough to actually receive the income. In some cases, people might plan it that way. And if you die before income begins, the insurance company will refund the premium that you paid to whomever your named beneficiary is. So, one planning tactic for people with money in a qualified traditional IRA is to purchase a deferred income annuity to eliminate some of the money they have in a traditional IRA, which will reduce their required minimum distribution once they reach the age they have to take them. This fact did not go unnoticed by the Treasury, and so legislation was passed that limited the amount of money that can be used to purchase a deferred income annuity in a traditional IRA. It even has a special name. We call it at that point a qualified longevity annuity contract. And in 2025, the contribution limit to a QLAC is $210,000. And the additional stipulation that you can only defer income out to age 85. I do want to point out that that restriction is only applicable to traditional IRAs. You don't necessarily have the same restrictions on a Roth, nor do you have any real restrictions if you're taking the money out of the bank or brokerage account and buying a non-qualified deferred income annuity. If you're buying one of these income annuities in a non-qualified nature, so it's not inside an IRA, the income that you receive from the annuity will be split between a refund of your cost basis, the premium that you paid, and gain earned on the annuity. There's a special provision of the tax code that uses a formula to figure out how much of your income is refund of your original purchase versus growth of the annuity. We call this the exclusion ratio. The insurance company that you purchase the annuity from will do this calculation for you and will tell you exactly how much of your income is refund of basis, which is not taxable to you, and how much is gain, which is taxable to you. Now, if you purchase a life contingent annuity payout option, eventually you may receive all of your basis back, at which point 100% of the income will be recognized as ordinary income and be taxable. When it comes to income annuities, one of the best pieces of advice I can give you is to not get stuck in the mindset that it's all or nothing. A lot of people who purchase income annuities purchase more than one, because they're trying to diversify or ladder the points at which they're starting to take income and what sort of guaranteed income they need to generate. So this might look like you purchase a single premium immediate annuity now that pays you, let's say, a period certain for 5 or 10 years, with the plan to purchase another single premium immediate annuity sometime in the future, 5 to 10 years from now. Or at the same time, you buy a deferred income annuity with the intention of delaying income for the next 5 to 10 years. You might also choose to purchase a single premium immediate annuity with a period certain income, and then use other assets or plan to have other assets grow in value and defer taking income from those places until the later date arrives when they become more attractive income options. It's also very common for people to use income annuities to fill in the guaranteed income amount they need for everyday living. Social Security is, for the most part, a guaranteed income source you can rely on, but it may not be enough to cover your regular living expenses. Think things like your grocery bill, your electric bill, your homeowner's insurance, things that you have a pretty good grasp of and know within a range what they're normally going to be. Buying something like an income annuity, a single premium immediate annuity, is a great way of ensuring that you have the monthly income to cover all of those expenses without having to worry about generating income from other places, which means it's not subject to the whims of the market and the possibility that asset values might go down. And now you have to worry about whether or not you should sell this thing right now, given its decline. And as we've already covered, a deferred income annuity, specifically done in the QLAC sense, is a way people reduce required minimum distributions. The multi-year guaranteed annuity, sometimes called the multi-year guaranteed rate annuity, is a unique annuity contract that operates very similarly to a bank CD. You pay the insurance company a premium, and they guarantee a certain level of interest that will be paid on that cash for a specified period of time. Generally something between 2 to 5 years. In some cases, we might see 10-year MYGAs. But you should know there are some very distinct differences between a multi-year guaranteed annuity and a bank certificate of deposit. First, insurance contracts are insurance contracts. They are not bank deposit products. That means they do not get depositor insurance like FDIC or NCUA insurance. In addition, the cash and interest accumulation on a MYGA, being an annuity, is deferred, whereas CD interest is recognized as income in the year it's earned. MYGAs, being annuity contracts, have surrender charges, whereas CDs do not. They generally have a penalty that is represented as a forfeiting of interest if you withdraw the principal balance prematurely. The penalty, as a surrender charge on a MYGA, on the other hand, could be substantially more than just forfeiting the interest that was earned. Because the MYGA contract is an annuity, and because it defers income for the sake of income tax liability, you have to be somewhat careful about how you exit a MYGA contract if it's a non-qualified annuity. So in other words, not sitting in an IRA. The contracts are generally designed to auto-renew into a new MYGA contract at the insurance company you bought the initial one from at the end of its guaranteed period. But if you don't want that to happen, and you want to instead move the money out of the MYGA contract, you have two options. You can cash it out, and at that point, you will recognize all of the growth of the interest from the MYGA as ordinary income. Or you can transfer the MYGA to a new company's product via a 1035 exchange and avoid any income tax liability. If the MYGA is sitting inside an IRA, then the tax issue isn't quite as dramatic because you wouldn't have a taxable liability until the money came out of the IRA. Generally speaking, MYGAs do not have any sort of guaranteed income component. You could withdraw the interest earnings on the MYGA and take that as income. A lot of other people tend to use MYGAs more as a conservative accumulation strategy. Again, similar to a CD. And in general, the interest rates paid on MYGAs is a little bit better than what you would typically find for a comparable CD with the same maturity date. So if you happen to really like CDs, MYGAs may be an option to get a little more interest income. Or if you happen to like CDs just as a conservative way to store your cash, you could use MYGAs as a way to gain a little more interest than you would from a CD. And since the interest earned is deferred in terms of recognizing it as income, you can compound the growth of a MYGA more efficiently than you can a bank CD. This is only true when we're talking about contracts outside of IRAs. If the CD or MYGA is inside an IRA, then there is no advantage from the standpoint of deferred income. The last style of income contract that we're going to talk about is what I am going to deem the accumulation to income annuity contract. This encompasses a broad range of different styles of annuity that include variable annuities, indexed annuities, and even certain fixed style of annuity contract. Generally speaking, these contracts do not have definite income features, but rather they accumulate an income benefit that is not as locked in guaranteed as an income annuity, but potentially higher in terms of what the guarantee will become later on based on non-guaranteed performance of the annuity contract. What that means is the cash value of the annuity is going to grow by some mechanism. On a variable annuity, it's going to be the investments that you choose. On an indexed annuity, it's going to be the movement of the index or indices that you choose. And on a fixed contract, it's going to be the interest rate that's declared annually by the insurance company. The income benefit of this style of annuity can come in two different options. It could be through what we call annuitization. That is essentially handing the contract in to the insurance company for a guaranteed income stream, much in the same way an income annuity would work. That option is far, far, far less exercised than the second one, which is making use of an income rider. Income riders generally work by creating a separate balance of money that operates differently than the cash value. Generally, the income rider cash grows faster than the cash value does. And this other bucket of money, if you will, provides a guarantee against it that you can withdraw for income that in most cases is guaranteed for your life. Oftentimes, this style of rider guarantees the income bucket will grow by a certain percentage for a certain period of time. Take, for example, something like the income bucket will grow by 7% per year for the first 10 years of the contract. So what the insurance company is doing is they're taking that initial payment you made and they're adding 7% to it every year for 10 years. After 10 years, you can begin to withdraw against whatever that balance has grown to based on some interest rate that is generally determined by either your age or the number of years you've owned the contract. That withdrawal amount is then guaranteed for the rest of your life, even if the cash value in the annuity is drawn down to zero. And with variable and indexed annuities, there's a chance that the growth of the investment account or the index accounts will push the income benefit up even higher than whatever that guaranteed number was at the outset. Now, one thing to be aware of is the fact that these income riders can, in some cases, complicate the calculation for required minimum distribution when you hold one of these annuity contracts inside a traditional IRA. The good news is the insurance company will take care of calculating the real value of your annuity contract, which you'll then add to any other IRAs that you have. But what you should know is the calculation for amount or value of the annuity contract is generally going to be something higher than just the cash surrender value of the annuity if you have one of these riders in existence. These income riders can have expenses associated with them, and these expenses will be deducted from the cash value of the annuity. Some people buy this style of annuity more so for its accumulation and not so much for its income feature. While it's certainly far less common, some people do purchase variable and indexed annuities purely for the investment account or the indexed account's ability to grow cash value of the annuity. That being said, the income rider feature is oftentimes a much more compelling reason to own one of these annuities than simply the accumulation of cash value by the investments or indexed accounts inside the contract. These style of annuity contracts definitely have surrender charges, and those surrender charges can last quite a while. So you should understand that this style of annuity contract is generally looked at as a fairly long-term commitment. The one exception to this are specialized contracts that are designed for investment advisors, because those contracts assume that the investment advisor is going to be charging fees against the cash value of the contract, and therefore they generally don't have a surrender charge. They do, however, also have a fee against the income rider if there is a fee associated with the income rider for the contract. Generally speaking, this style of annuity contract is a single premium contract, which means you can't make additional contributions to it in years later. There are a few exceptions to this, but not many. This style of annuity contract is also very commonly laddered in the same sense that I brought it up for income annuities. One might buy multiple annuities with the intention of starting income at different times. It's also very common for people to coordinate this style of annuity with an income annuity. Perhaps buy a SPIA for a 10-year period certain, also at the same time buy one of these style of annuity contracts and let the income rider accumulate over a 10-year period before commencing income with this other style of annuity. We might find that we can optimize income at this point because we took money from the SPIA for 10 years, then we let the other, this accumulation to income annuity grow over that same 10-year period, and that results in a much, much higher income coming from the second annuity contract by waiting 10 years versus starting the income immediately or 5 years in, as an example. While they're all a little different, the one thing that should be very clear about all annuity contracts is that they do guarantee certain features right from the outset. And with the exception of MYGAs, income annuities and the accumulation style annuities can absolutely guarantee income for a lifetime. And for many, many retirees, that is an extremely helpful asset to hold when it comes to generating the necessary income that they need in retirement. Annuities are very heavily affected by interest rates in the broader economy, and given what's happened post-COVID to interest rates, annuities have become significantly stronger and more attractive sources of guaranteed income because those numbers have risen significantly during that time frame. What's cool about this is once an annuity contract is purchased, even if interest rates turn around, all of the guarantees in terms of income under the contract never change. So if we return to a much lower interest rate environment in the broader US economy, but you purchased an annuity contract that has an income that is supported by interest rate levels of today or a year ago, your income is not going to change because interest rates go down. In addition, insurance companies are very well positioned to deal with the task of providing you with consistent lifetime income. While my examples were done in yearly terms, most of the income payouts from annuities happen on monthly timelines. So while annuities can be a little intimidating at first, it's well worth investigating what they bring to the table because guaranteed income can untangle considerable uncertainty people face when it comes to retirement income.